Hey everyone, hope you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go over some questions that people were asking me or are asking me. They are platinum members of the community, and I'm going to record it for everyone so you guys all get it. And it deals with, and I'll read you guys the question, but it deals with AI and will AI stop the rotation or slow down the rotation of money that is seeking commodities or inflation protection. And I'll read the question here verbatim. So the question is, when you talk about money flows and your opinion that they will eventually make that way into commodities, have you considered that the flow can possibly be diminished than previous bull markets due to the competition for those resources from AI? I'm reading that the AI boom will more likely be sustainable than the previous dot-com bubble, and wondering what your thoughts are. So I'm going to go in, we're going to look at some data, and I think a lot of people think this during bubbles. I don't think it's going to be different. I don't think that AI will steal any large chunk of money flows. I don't even think cryptocurrencies will. And obviously that's just an opinion. I don't know for a fact, but that's my opinion around it. And what I think is going to happen is interest rates will continue to go up over the big long period of this bull market, and it's going to rotate money away from the things that people want towards the things that people need. And their costs are going to force them to do that. It's not going to be an option. And really what you need to understand, I think, is what are the drivers of it? Why is it occurring? And does artificial intelligence either slow that down, or why would it steal market share? So let's just look at some stuff in history. You guys can obviously make up your own opinion and have your own opinions, and it can obviously be different than mine. But we can look at the current situation using charts. I'll try to describe it as best I can using the charts and how I am interpreting the data. Obviously, what I'm saying here could easily be debated, probably 5 different ways. And everyone's going to have a little bit different opinion on it than maybe I do. But this is the way that I view it. This is the way that what I've learned from history and how I've kind of made sense of it. So let's dive in. Let's see what's going on here. Right now, I've got the 2-year yield. And the 2-year yield, you can see, and I just put one big fat trend line in there. The red line was the last commodity bull market. And if we look going forward, the beginning of this commodity bull market was about here. So we've got commodity bull market, commodity bull market. There's a big difference between these two commodity bull markets. The one that occurred from 98 to 2011, which was a bull market for precious metals and a lot of commodities, that bull market occurred in a declining interest rate environment. Notice that we've got a trend line, and that occurred during a declining interest rate market environment. So this bull market that is coming is different. It's not like the mini bull market here. This is a major one. We've broken the downtrend line here, and money is more likely to flow into it because we're going to see, and we have seen, a larger increase in the percent of interest rates. So in my opinion, when I look at all this stuff, one of the main drivers that causes money to rotate obviously is inflation and interest rates responding to that inflation. So they created all that money, that stimulus money. We had a big boom in the housing market. And all that stimulus money and all the money that was created during the big boom in the housing market. And what I mean by a boom in housing market, I'm talking about the housing starts. That is where the origin of credit creation is coming from. So if we look at housing starts, and we're going to bounce around here a little bit, guys, so you can get a whole background. And this isn't scripted. I'm just kind of talking off the top of my head here. So if we go to the housing starts, which is here, housing starts are at 1.452 million for the month of July, which is above average. Average is where this line is. It's about 1.1 million is what I did some research to actually find what the average is. And it's about 1.1, 1.2, somewhere in that range. So we're above average. We are putting more credit into the system, which is inflationary. So last commodity bull markets, where they really heated up, was the upper portion of the expansionary phases of real estate. They're all up here. That's where we're at right now. That is inflationary. It expands the currency supply. And that is where the money is coming from. That is going to be inflationary, and interest rates chase that inflation higher. And then money rotates differently in the system. Another source of inflation comes from deficit spending in governments. And the interest rate is now having an impact on that spending. So we've got the 2-year here, and you can see that we have just gone massively higher in interest rates. And if you look at a lot of my clips, I talk a lot about the interest expense and how it's been going up dramatically. It's due to the interest rates going up. So what the government is trying to do is they're trying to fight the credit expansion phase in the real estate market by increasing interest rates and slowing down the inflation in the system due to these new homes coming out on the market. The problem is they're in a position where they're kind of screwed. I talked about that during the Palisades interview I had with Tom in 2021. I said they're backed into a corner. If they increase interest rates, they're going to run very large deficits. And those deficits are going to be stimulative, or they're going to be inflationary because that money's coming into the system. And then on the housing start side, they're screwed because they can raise rates, but you're still stuck with a shortage of homes. So how do you get out of this? If you build, a lot of people will say the way that you get out of it is you build a bunch of homes. The problem is, if you build a bunch of homes, that means that a bunch of new loans are going to go against those homes. And those new loans are inflationary. So you can't solve the credit expansion problem of not building enough homes in a non-deflationary way, or a non-inflationary way. So whatever they do, I think they're going to get inflation. So if they try to slow down the United States housing starts from going up by increasing interest rates and making housing less affordable, it's going to be inflationary through the avenue of interest rates and the deficit spending that the government's going to do. So that's inflationary. Now, if they don't increase interest rates, they're going to get inflation from the credit expansion of new homes coming online. So you can see, obviously, those interest rates rocketing higher has slowed down the building of new housing starts. And they're getting inflation from the deficits. If they reverse that, they're going to get inflation from the housing starts. They're screwed either way. So what they're trying to do is they're trying to handle an outcome that they can't. They're trying to handle an outcome. There is no solution to this problem. It is a predicament that they're in. A predicament means that you don't have a solution and that you have to handle outcomes. It's like you accidentally fell off a cliff and you're heading towards water and you have no solution. All you can do is you try to hit the water feet first and don't belly flop the thing. That's what they're doing. And that's the situation they're in. Now, those are the drivers of the inflation on the inflation front. Your question is, will AI steal some of that money? And so you know where the inflation's coming from. It's from those two avenues of the inflation avenues. It's the housing starts, and it is the deficits that they're going to run. The thing that is causing this rotation are yields. So yields are causing the rotation of money flows. What happens is the inflation that I just described, where those things are generating the inflation, that's going to generate increasing interest rates because they're trying to slow down the housing starts. So that's why we're getting this large increase in the 10-year yield and also the large increase on the 2-year yield. So that's why these are going up. That's why he's trying to slow down that credit creation in the housing starts. Now, AI is not going to do a single thing about that. So, and I'm talking from a practical standpoint, not from an investment standpoint. Technology and artificial intelligence just makes things more efficient. If you were to create a way to make houses more efficiently, you're just going to get more inflation if they're putting loans against those homes. So that's still going to cause inflation, and it's still going to cause interest rates to go higher. Interest rates are causing this rotation. So inflation is what is causing interest rates to go up. Inflation comes into the system. People who own bonds, we can use TLT for that. What they do is they are going to sell those bonds because of the inflation. And when they sell those bonds, money is leaving the bond market and going somewhere else. That is what's increasing the interest rates in the system. The inflation is the cause. The two drivers of that cause is the interest payment or the interest expense, the deficit spending, and the credit creation in the real estate market. That's what's driving. They can't stop that, I don't think. Now, we can have a move lower here, and this could obviously come back up and do a retest or something like that. We can have a slowdown in the market. And that slowdown in the market is going to occur from the interest rates. So the interest rates going higher is going to cause a slowdown in the markets. And the problem is it's not necessarily going to reduce or eliminate the inflation necessarily. The drivers are still going to drive if the market slows down or not. And if the market actually slows down, you could see increased deficit spending because their tax revenues will decline if the economic activity slows down. And if GDP goes down, gross domestic product, and the money keeps increasing, it's actually more inflationary from that perspective if interest rates remain high. So one of the drivers is the interest payments from the deficits and your tax revenues. If we get a big decline, what happens is their tax revenues are going to decline and the deficits even get bigger and larger. Their tax revenues would come from the S&P 500 and NASDAQ. And in my opinion, with the increasing interest rates, I think this is going to roll over and go lower. Right now, even in the short term, we have a bearish engulfing here and another bearish engulfing here. To me, this looks like it's going to go lower. That's going to impact people's portfolios and the profits and gains that people have in their portfolios. And their tax revenues, the government is going to decline from the investment tax revenue standpoint. NASDAQ is in the same situation. I think we're going to roll over. These are your two bearish engulfings and probably go lower in the short term and maybe even longer than that. And the interest rates are causing that rotation. So this is your first move. This is your bull trap. and then they're going to get hit to the downside, I think. So that's what I think is going to occur. That's what I'm seeing. It doesn't necessarily mean that I'm going to do anything with shorting it. I'm going to go long what's good with gigantic asymmetric bets. All of the data that we've got on the charts are signaling that commodities are bottoming and that rotation of money is already occurring. So if we were to look at the commodity to stock ratio, which we have right here, this downward movement from circle to circle, that's where stocks outperformed during this period and money went into stocks and not into commodities. That's how this ratio went from very expensive to very cheap, is that money was rotating. And if you were to look at the reasons why, the inflation drivers were not driving a lot of inflation. We were at a very low level of housing starts during that time frame. So if I were to pull up the United States housing starts to show you guys, oops. So I'm going to put it on a new pane underneath. We were at a very low level. If you can see where the peak is, we were coming down and we came to a very low level in this general area here. And we were not building a lot of new homes. In fact, we were at ridiculously low levels of the homes that we were building in relationship to history. We were at the lowest levels ever. So what that means is that we weren't really creating inflation. The driver of inflation, which is credit expansion against new homes, was not being driven. And that's what drove the commodity to stock ratio down to levels that were at 100-year lows. The market conditions were ripe for money to rotate into bonds and into stocks because of no inflation driving. And we can see that with the 2-year yield going to incredibly low levels down here. So the interest rates are what price assets. That is what prices the NASDAQ, because the NASDAQ, they're all growth stocks. Growth stocks, when you calculate their net present value, is calculated with the 10-year yield. And when this goes and declines, it's a tailwind behind growth stocks to continue higher over the very long time frame. So since 1981 and 84, the way that we came from 84 onward, we had a gigantic tailwind for NASDAQ and S&P 500 to be priced higher due to a decline in interest rates. And when you do future cash flows discounted to today, they use the interest rate on the 10-year yield. So they were using the interest rate down here of 0.6. Today, we are at 4.24, a massive increase in the interest rates. In my opinion, the S&P 500 and NASDAQ have not accounted for a 4.24% interest rate in their calculations yet. So what you're going to see, in my opinion, is the market conditions caused this 100-year low in commodities, and it pushed all of the money into stocks and bonds. As we saw with TLT, money's coming out of the bond market. That's why it's declining. That's why we went from $170 to $95. It's gotten absolutely decimated. Money's coming out of the bond market. Money is rotating and selling bonds because it wants out of that market due to the inflation. Money is going to start to rotate out of the S&P 500 because of the interest rates increasing and the declining interest rates changing to an inclining interest rate environment. And we've got our bearish engulfings, and I think that's going to occur here right now. That's what I think. If you take a big picture view of other commodity bull markets, we had a bull market here a bull market here, and a bull market here. And we entered one right where we're at today. If you notice in those commodity bull markets, the S&P 500 went sideways during each of those commodity bull markets. Why did it do that? And what is the drivers of it for each of those bull markets? I'm going to focus on these two over here. This is the 1970s. We had a very large increasing interest rate environment. The demographic of the baby boomers came into home buying years, and credit was pushed into the system. The interest rates caused the S&P 500 to go sideways for the better part of a decade. That is what drove it, in my opinion. If you look at it from this one back here, this was also a housing market boom, expansionary phase of real estate. And we went into an expansion phase, and that was credit coming into the system and an increasing interest rate environment, and money chose to go into the commodity markets and away from the S&P 500. Both of these eras were commodity bull markets, and they both went sideways in the S&P 500 and NASDAQ. Money was being drawn from this sector into commodities, and we can see that in the commodity to stock ratio. This bull market was bigger for commodities than this bull market was. The reason that was the case is because interest rates were increasing. They were going into an increasing interest rate environment, and this one was in a declining interest rate environment. This market here, I think, will be similar to this market here because the interest rates are in an increasing interest rate environment. So if we were to look at this and tie this all together, if we go to the commodity to stock ratio, let's go back, let's go to a very large commodities to stock ratio and look at a very long-term chart. So if we were to look at a really long-term chart, the 1970s, it was low here, 99 was low, and 2020 was low. They were expensive in 73, 74, and 80, 90, and 2008. If you were to overlay all this, sorry, we're almost off the chart here. If you overlay all this and you were to look at all those time frames, I wish I had more data on this one. 1970 was where this green arrow was. 70 to 80, 99 to 2008, and then we had 2020. The commodity stock ratio was cheap here, expensive here, cheap here, expensive here, cheap here, and we haven't gotten to an expensive area. The money rotated. I mean, the technology was far better here than it was here. And what you're saying is, could this slow down? No, I don't think so. I don't think that AI has anything to do with the drivers of what's driving the rotation of money. And I think that the drivers of this over here are going to be stronger than probably any time in history. And the reason I think that is because of interest rates. Interest rates are coming from a level that was a blow-off low, broke the downtrend line, and are going to move to the upside. It doesn't mean that we're going to go straight higher. And that's not what I mean. There's going to be times where it looks like I'm wrong, but I'm still right. And what's going to occur, and the reason I think that might occur, at least at some point, is this is your decline in interest rates on the 2-year. We could have a market slowdown where this comes back down here and then goes back up again. What that's going to do, and the reason it would do that, is the market slows down so dramatically, GDP gets hit, tax revenues get hit, that Powell needs to reverse course. He reverses course because the economy slows way down and things start to implode. He can't have an implosion in the economy. You can't implode your tax revenues, and he can't continue to increase interest rates if that were to occur. When is that going to occur? I don't know yet. We're probably seeing a slowdown already, and we're in stagflation, which is a slowdown in the economy, and we're getting inflation on top of it. The problem we're getting at is he's stuck in that position that I described before. The interest payments and the deficits that they're running, and then the credit expansion in the real estate market. But if the economy eats it, he could lower interest rates. And he's going to have to give up on fighting inflation, because the inflation is going to come no matter what he does. Inflation's coming if interest rates go up. Inflation's coming if he lowers the interest rate, because he's going to get it from the credit expansion of real estate. Now, the only way he can stop inflation is he just completely dive bombs the system. Or they do something to stop the economy. They try to slow it down, which could be, someone was talking about, could there be another COVID closure or something like that, where they slow everything down this winter? I don't know. They're losing control and they're going to get desperate. And commodities are about to launch. And the only way that they can slow that down is to literally shut down the economy. The interest rates aren't going to stop it, because you're going to get inflation from deficit spending. So if they dive bomb the economy, they can slow it down, they can stop it for a short while, but they can't stop it forever. They're going to have interest rates dive bomb back down. If they do that, if they were to shut down the economy, people are going to run to bonds. They need people to run to bonds. So they could engineer a crisis where people run to bonds, and there's their demand for bonds. It's going to lower the interest rates. They're going to flood the market with bonds, and they're going to create that demand for the bonds by crashing the economy. That's possible. That is very, very much possible. But when the interest rates go down, you're still going to get inflation, because people are going to go buy homes. They're going to say, this is a great opportunity to buy a house. I can now afford it. Boom, you're going to get a big boom. So I don't know how they're going to do anything around that. AI, I don't think AI is going to do anything. I think AI, if you were to look at, say, like NVIDIA, I think there's no way. If you showed me a chart like this, there's no way I would buy up here. Not a chance in HELL. Not a chance. Maybe a chance if I were to buy down here, or maybe down here, or maybe down here, but no way at the peak here. There's too much risk, not enough upside. And this company is a 1.13 trillion market cap, NVIDIA. Now, maybe this works good for the long term, but you can see we're getting a lot more selling pressure up here. So I don't know. I'm not in this camp. I think that a lot of these growth stocks are going to roll over and they're going to start going lower. This is another bearish engulfing pattern here for Apple. I think that this is probably going to be a topping pattern, and we're going to roll over. And it's one big topping pattern, which takes a couple of years. Most people are going to get this wrong. The reason they're going to get it wrong is they have no idea what the heck's going on. They don't know what I just described. They don't know the drivers of inflation. They don't know why interest rates are going up. They don't know the impact of interest rates that they have. They don't know the time frame that this occurs on. The time frame takes years for a topping pattern to occur with these interest rates going up. It's a process. They don't know that money's rotating to commodities. They don't know any of this stuff. And that goes for the majority of people that work in the financial industries. The CRB to S&P 500, if you look at this, we've broken this downtrend. It's a new paradigm where commodities will outperform. That's the downtrend that's broken. Interest rates and the inflation drivers are causing this rotation. AI and the money rotating into AI is not going to steal, I think, any money. I think it's actually a marker of a bubble like the 2000s bubble, the NASDAQ bubble. I think we're in a NASDAQ bubble. The 2000s bubble is going to be nothing compared to what could potentially be coming. And why is that? Because interest rates. I keep going back to interest rates. You notice that? If interest rates continue to go up like they did in the 60s and 70s like this, so you had an increasing interest rate environment back here. The interest rate environment ended with a head and shoulders top. There's your head and shoulders top. See that, this topping pattern here? That's a topping pattern which put us into a decline in the interest rate, the interest rate environment there. This pattern here, if I were to just take this pattern and show you guys how this all interconnects. This is your topping patterns. This guy right here, okay? There's your topping pattern. I'm going to copy this. And what I'm going to do is I'm going to go to XOP and just show you guys something. This is the topping pattern that we have here. There it is. That's the topping pattern on interest rates that I have. What I'm going to do is I'm going to right click this. I'm going to, I think it's mirror it. There you go. This is mirror. And what we have is a bottoming pattern in oil. And this here is going to be a very large bottoming pattern. God, this thing is sensitive. And there's your bottoming pattern that I think we have. So what this is inverted head and shoulders. This was a peaking of a head and shoulders for interest rates. There's your shoulder, your head, and your shoulder. This is your shoulder, your head, and your shoulder with a neckline here. So the topping pattern that we had in the 1980s is basically a gigantic bottoming pattern that we have today in oil and all of these different commodity sectors. And really, what's the big driver of this is interest rates. So if you were to look at the big interest rates that I just showed you there, this pattern here, that's a topping pattern, which resulted in a decline in interest rates for that period of time. Now we are literally reversing this. We have a bottoming pattern of an inverted head and shoulders that is coming up, and we're breaking all of the, we'll call it the pricing structures in the market. We're breaking the pricing structures in the market. And I just made that up, guys, right now. And the pricing structure was a declining interest rate environment. Now we're in an increasing interest rate environment. We're just starting it. That is what's going to cause the rotation of money. The pricing of AI is determined off of the interest rates. And the NASDAQ, which is basically the AI companies, are going to get destroyed based off of the pricing mechanism in the market. The underlying pricing structure that everyone is using is based off the 10-year interest rate. And the 10-year interest rate is now moving higher and has broken the 40-plus year downtrend in interest rates. And I don't think anything in the NASDAQ is going to change. Nothing's going to change this rotation of money. It is being driven by those two drivers, and I don't think they can stop those drivers. So I think that they are handling an outcome. There is no solution to the inflation problem. Inflation will be persistent, and if they raise interest rates, you're going to get stagflation. They're going to kill the economy, and inflation will still be there because of the debt of the interest payments, the deficit spending. If they try to solve the deficit spending, they lower interest rates, and the credit expansionary phase of the housing market is going to increase. They are pinned into a corner and can't solve it at this time. They can only delay. And I don't think that they can solve this problem with the housing market without building those homes. I think they have to build the homes. I think the inflation will have to come. And if they don't, they'll just stretch it longer and stretch it all out. The NASDAQ is going to be subject to a very large increase of interest rate. And if we were to come back to that, and I don't have data before 1960s, the NASDAQ didn't do much in the 70s here. When interest rates basically bottomed, that's when the NASDAQ really started to take off. And that's because the pricing structure under the market of the interest rate was declining that entire time. So not only did we have low inflation and money started to rotate into the NASDAQ, the pricing structure drove it to levels that were at incredible historical differences. And that is how we got 100-year lows in commodities, it's because of the interest rates. All of the money piled into stocks and bonds. All of it did. That's how we got the 100-year low of a commodity to stock ratio, is because the market conditions of the interest rates and the low inflation drove it all into that and into these assets. And now, because the interest rates are going into an increasing interest rate environment, we've broken that 40-year downtrend. Now money's going to rotate back. That's really the whole thesis of the channel there, guys. That's why we're going to have the largest commodity bull market. Now, one can ask and say, well, what evidence do we have of this? Well, commodities are all putting in bottoming patterns. I've showed you that for many, many days. Double bottoms, inverted head and shoulders. These are big bottoming patterns. I can show you a large. I don't want to, for the sake of the members, I don't want to show this stock. So I'm gonna remove this, and I'm gonna remove the symbols here for the sake of this. I'm going to pull up a company that I'm going to show you just how big some of these bottoming patterns are. So I'm going to yank up this one here. I'm going to go to all, and then I'm going to go to logarithmic. Okay, or no, not logarithmic. So this here is a stock that we have money in. This is the bottoming pattern. And you can see when we broke this bottoming pattern, this is what had happened. This is a 100 bag, 100 times your money. We had a big decline. If I were to throw, some stuff on here, here's your declining interest rate environment. Oil was out of favor. This is an oil thing. We came in, we had one hump, two hump. The third hump is all the way down here. So usually these have like three big humps. So you've got one here, two here, and the third hump here. This is a big consolidation. We've broken out of that consolidation. We've been moving sideways. And this here has got a ton of leverage. It did a 100 bagger for this big kind of lead-in pattern. This is your consolidation. The way that you generally do this is you take basically the index here, you put it up like this, and that is what your projected move could be, is back to the top here. If it goes to, almost about, $927 from 64 bucks is what it's at. That's a big move over. Now this isn't going to be overnight. This is going to be a long, big picture view move to the upside. But this is a bottoming pattern, guys. This is your bottoming. This is your bottoming. If I were to zoom in on the left-hand side there, and try to show you guys what it looks like, what I'm going to do is I'm going to zoom in on it. I'm going to go logarithmic. I'm going to zoom in over here. What do you see? Well, this is an inverted head and shoulders. It's the largest inverted head and shoulders that you've seen. If I were to take a bottom to top move here, and I'm on logarithmic here, so I don't know if this is going to occur or not, but and we go to the breakout, well, that puts us at $1,200, back to the high. If you notice, I did two ways to calculate where this could potentially go. And I get around $1,000 either way I calculate this. Remember, we had that pattern, this pattern here that was the topping pattern of the 1980s of the interest rates. Now, if I were to mirror this around and flip it, and then I kind of, this is real sensitive, and I grow this, what does this look like? Oh, wow, that's a bottoming pattern, isn't it? It's a bottoming pattern that we're getting right now in all of these stocks. If I were to pull another company, here's another one that we are investing in. I'm going to pull from over here. So here's another one we're investing in. I'm going to go off logarithmic just to show you the magnitude of this. We've got a bottoming here. We have another bottoming pattern here, and we have another bottoming pattern here. Look what happened after these bottoming patterns. Gigantic moves higher. What I am proposing is that we could move to a level which is absolutely ridiculous, where we go to a level that could be somewhere up here where we hit the peaks of this and go up to a level. Now, if you look, this is $16 to $2,500. That's bottom to top of last bull market, which occurred in 1988 all the way to 2008. Now, that's a 20-year bull market. 20 years. Yes, it took a long time, but you got an absolute ridiculous return. That's the types of returns in the long-term, focus I have on the markets. I'm investing in these companies for very long-term investments. And if we look at this, all of the right market conditions are aligning for this potential move to occur. Now, is it going to go all the way to 3,500? I don't know that for a fact. But it is possible. And with the setup, I think it is very possible. Now, I'm sharing all these companies with the members. This is what I'm providing. I'm giving you guys long-term, very big picture view picks for patient investors. And I know some of you guys want to make it even earlier. If we zoom in on the right-hand side here, and I were to zoom in on it, what do we see here? Let's go logarithmic. You know what this is called? It's called a shoulder, a head, and a shoulder. That will eventually break to the upside. Why am I so confident that will occur? Because of the shortages in oil, because the interest rates going up, because the inflationary drivers. The inflation that I'm talking about, that the predicament that the Federal Reserve is in, is going to be driving inflationary sensitive assets to the upside. Oil, precious metals, they're all going to go up because the drivers in the system. So I'm not talking about just the technical analysis. I'm describing why I'm a hybrid investor. I'm a hybrid investor because I think that they can't stop this move from coming. They can delay it. They can push it down in the short term. Long term, what are they going to do? They have to build the homes because they want to. The market is seeking a balance, and those homes will be built. And if they lower interest rates, those homes will be built even faster, which will be inflationary. If they keep the interest rates high and try to slow down that credit creation, more money is going to come from deficit spending. What are they going to do? If they go in the middle, then you're going to get inflation from both ends. You're going to get it from the housing market. You're going to get it from the deficit spending. In my opinion, they're kind of screwed. So what am I going to do? I'm going to load up on inflation-sensitive assets. These ones that possess these gigantic big bottoming patterns, I'm going to put a bunch of money on. Why not? Why not sit in them and just wait? There are ridiculous setups with a bunch of dividend being paid out. 20% dividend yields, 15% dividend yields, 10% dividend yields. They're all over the place, guys. If we're going into an inflationary period and I can buy these big companies with dividend yields that are real big and they've got a bunch of production out in the future and they can grow their production still, I'm going to load up in it. Why not? And you know what's going to happen? Inflation is going to come. Interest rates are going to remain elevated or go higher. Money's going to rotate. And when money rotates into oil, because it's inflation sensitive, then that's going to increase oil prices. And when oil prices increase, what eventually will happen is people are going to chase returns. They're going to chase returns. They're going to sell their NASDAQ. They're going to sell their S&P 500, just like the 1970s and the 2000s, like I showed you in that big long-term chart. The commodity to stock ratio is going to rotate upward. And it's already underway. This is already underway. This isn't just me saying this. Here's your commodity to stock ratio here, guys. This is already underway. And you can see that we're probably entering wave 3. Wave 3 is the biggest increase of a move where commodities are going to outperform the S&P 500. You know how you're going to get that big increase? You're going to have the S&P 500 and NASDAQ roll over at the same time that you're going to have commodities go up. And he's going to create a stagflationary environment where the economy slows down due to interest rates, but the inflation is still persistent from deficit spending. Money's going to rotate into commodities. You're going to see the biggest commodity bull market in our life in relationship to other assets. That's going to be a combination of commodities going up and equities, stock equities of companies going down. It's going to be a combination of those two things. It's not going to all come from one side. The problem they're going to have is they want more tax revenue. And they're stuck in a bad situation where if their tax revenues decline at the same time that deficits go up, you're going to get more inflation because you're destroying the driver of lowering prices through economic activity, through the efficiency of creating more things in society. So we could see a very bad inflation, another big wave of it. And that wave is going to cause the rotation. It's all interconnected here, guys. If oil goes to these ridiculous levels, which I think it's going to, because it's inflation sensitive, it's also going to cause a huge move into precious metals because people are going to start to worry about the currency. They're going to worry about the deficits. And that's going to cause a run on precious metals. So the way that I would think that this is going to play out is energy and food and the things that are real, tangible items are going to increase in value because of inflation. I'm describing the market conditions here. And precious metals, people are going to run at some point. They're going to run a bunch of money at precious metals because bonds aren't working and the stock market isn't working. Where do you put money? Where's all these trillions of dollars going to rotate in the market to something else? It's going to rotate into commodities, precious metals, and real estate. Real estate's an inflation hedge. It's going to transfer away from bonds, stocks, and those financial assets. And then that ratio that's at 100-year lows is going to come back to 100-year highs, where commodities are going to be they're going to outperform stocks, and they're going to go to some ridiculous level on the opposite end of the spectrum. We are vastly underinvested in all of these other commodities. I mean, vastly underinvested, guys. The setup here is just ridiculous because you've got it from both sides. You've got it from the credit side, where they're trying to handle that predicament. And then on the supply side, it's all screwed up. So we can't respond fast to the credit creation. And it's going to cause a large increase of our cost curves moving up. So the way that I would play this is I would look at energy because that's the most it's the most inflation sensitive asset. Platinum is another one that is inflation sensitive. Then you look at the other side of things. You could buy the physical metals because the cost curves are going to continually go up. And the least risk way to play it is to just buy the metal. Like, that's going to go up. Like, if it's below the cost curve right now, it will go up, period. It's just a matter of timing then. Because inflation, if you've got inflation, you've got stagflation, well, you're going to produce a lot less if you can't produce it. And if you look at the silver mining companies, they're all in the 20s now. A lot of the high cost producers, $20-something an ounce is their all-in sustaining cost. And same with platinum and all these other ones. The cost curves are going to go up. So another really good way to play this would be royalty companies. They're not sensitive to the input costs. Or you just buy the stinking metal and you just eliminate all the risks with governments, because governments are going to try to tax all this, guys. They're going to try to tax it. They're going to try to take your money. They're going to try to take the gains, and it's just going to make the pricing worse. It's going to push pricing even higher. And if it pushes prices higher and you own the physical metal, you're set. You are set. And if you're playing the ratio game that I'm teaching on the channel here, then you just have to sit in it. It's not hard. You buy it. You buy what's cheap and just sit in it. Now, remember what I said about that. We had a declining interest rate environment with very low inflation. All the money went into what? Those assets that perform well under those market conditions. What performs well under that? S&P 500, the NASDAQ, Palladium is generally a metal that works very well under that condition. And you know what hasn't worked well? Platinum. Platinum works very well under an inflationary environment. They even did a study, Yale did a study, a couple of guys at Yale, and they looked at it and they said, well, when platinum outperforms gold, that means you're in an inflationary environment and that stocks will underperform precious metals and all that. And what do we have here, guys? I'll even yank up that ratio of platinum in relationship to gold. So if I were to yank up that, that's this here. This is the platinum to, you see here, 1 second, guys. Oh, it's canvas. That's where it is. Watermark. Platinum to gold ratio. And what do we see here? Topping pattern. That's a Batman pattern. All the way down during that recovery phase. And now we break to the upside of the pattern, and we are still very cheap. That will go higher based off the market conditions. How do I know that? I did my homework. I did a lot of homework. I did so much homework, it was ridiculous. I could write a freaking PhD thesis on this thing. But yeah, that's what it's describing. Platinum is going to outperform gold. We haven't started the big move yet, and it'll come. And people are going to say, well, platinum hasn't gone anywhere for all those years. I just described to you why it didn't go anywhere, why it's going to change. Interest rates breaking the downtrend, inflation coming, how they're in a predicament. That's not a problem. You can't solve it. I mean, maybe they can delay it. Obviously, we can get setbacks during this bull market. They could shut down the economy again. That is possible. I don't know if they're going to do that. No one knows outside of them. So, yeah, to me, I think it's fairly obvious. You can see it across the entire board. You see the bottoming patterns, the topping patterns in interest rates in the 1980s. It's like the bottoming patterns we see today. We have a clear downtrend break in interest rates. We've got bottoming patterns in all the commodity companies. We have bottoming patterns with platinum versus gold. That's signaling an inflationary environment. We have oil outperforming. We have oil outperforming gold to tie this all together. So here is, I'm just going to yank it up. Here's crude oil versus gold. Here's your inflationary environment, your disinflationary environment. And now we're going into, quote, a inflationary environment where crude oil could outperform gold for a period of time. Remember that company I showed you, 1980s, all the way to 2008. There's your ratio. And what do we have here? That just broke out. You're going to see some of those companies outperform again. So, unbelievable how I figured all this out. I don't know. Yeah, that's what I'm seeing here, guys. And again, if you want to know all these individual companies, I'm like literally scavenging everything. We've got all the people in the community also scavenging the companies, asking me, what do you think of this company? What do you think of this company? And we find new companies all the time. And I'm loading up in these dividend paying companies. And remember, the dividends are going to increase, guys. They're not going to go down. They're going to go up. Now, they could go down in the short term. Fine. But when oil goes up, when fertilizer goes up, when whatever these things go up, your dividends are going to go up. The stock price will go up and the dividend will go up at the same time. Cash flows are going to go up just to ridiculous levels, guys. I don't know how I can describe the setup here any cleaner than what I have. That when these cash flows go up, they're going to be paying just ridiculous amounts of dividends to the money that you put in today. It could be over 100% of what you put in. So if you put in, I'm just going to give up a number, okay? You put 100 grand into a company that's paying a very big dividend, or 50 grand, or whatever it is. I think that they're going to pay dividends in a yearly time frame more than what you put in today. You're going to get bigger amounts than 50 grand than what you put in today, or 100 grand in the future when the price goes up and remains elevated for a period of time. You're going to get larger returns than what you put in on a dividend yearly income basis back. So if I put in 100 grand into a company, I think I'm going to get 100 grand back per year in dividends some years out when oil and fertilizers and all these things go up. I think that is definitely possible. And the reason that is because oil prices are very low right now. And they're going to go to a very high level. They're going to probably be at a sustained high level. And we're going to get huge payouts. That is my vision because of what I just described here. Does it mean that vision will play out perfectly? No, it doesn't mean it will play out perfectly. But I think it's possible. And I think the likelihood is high. And everything that I pull up is signaling that crude oil could outperform gold here for a while. If that's the case, that means that crude oil is a pretty good spot to be. And uranium and all these other ones that we're looking at. I think I've got the best companies. Fingers crossed. What did I use to figure out these companies? I do fractal analysis. Fractal analysis is the size of the first wave. That's it. That's what I've done. And I think I've identified all the best ones. And guess where my money's at? It's in all the best ones, scattered across. So again, if you guys are interested, you can join finding-value.com. There's a discount code called discount if you want to join and see the companies that I like. I'll show you everything I know. And if you're there for 5 or 6 months, you get the companies, you see kind of how I view things. That education that you're going to get is going to be more valuable than anything you can find on the market. It's going to be more valuable than trying to go find YouTube videos. There's only a few guys that I think look at the markets the way that I do in the way that I view it. Or you can just sign up to this YouTube channel and listen to the clips because I do disclose a lot of information on them. But that's what I've got for today, guys. I think this is enough. This is, I think, one of my longer videos. It's almost 60 minutes. But yeah, give me a thumb up for the content. Subscribe to the channel. And I'll keep talking about all these different topics, guys. I don't think AI is going to do anything. It's not going to take any money. It's not a part of the driver. AI stocks will get priced lower, even though their earnings could go up because of interest rates, which is a possibility. Maybe some of the best AI companies may still go up. That's possible. But looking at like NVIDIA, which is the hot stock right now, all I'm going to say is very expensive. And given where the market conditions are at, I wouldn't touch it with my money. I could be wrong though. Maybe it goes up and everyone's going to say, oh, it still went up. But I mean, what do you expect out of it, guys? You expect it to go up 10x? Do you think it's going to be a $10 trillion plus market cap? It could. But I don't know. I think some of these other companies are way better priced. Way better priced. And have larger upsides than NVIDIA. 100 times upsides maybe, or 50 times upsides, or whatever it is. I don't think NVIDIA is going 100x. There's no way. It's not going to be a 100 trillion market cap. Maybe, but I just don't think so. Not in these market conditions. You're going to have a declining interest rate environment. But that's what I got for today, guys. Yeah, we'll catch you later. This is Finding Value.